Natural gas prices are influenced by many factors, but the most important ones are supply and demand. In this section, we will look at how to analyze these factors and use them to improve your natural gas trading game. Supply is the amount of natural gas that is available in the market. It depends on the production, storage, and transportation of natural gas. To analyze supply, you need to monitor the following indicators. Production. This is the amount of natural gas that is extracted from wells or imported from other countries. You can track production data from sources like the U.S. Energy Information Administration, EIA, or the International Energy Agency, IEA. Storage. This is the amount of natural gas that is stored in underground facilities or liquefied natural gas, LNG, terminals. Storage levels reflect the balance between supply and demand. You can track storage data from sources like the EIA or the Natural Gas Storage Report, NGSR. Transportation. This is the amount of natural gas that is moved through pipelines or shipped as LNG. Transportation capacity and infrastructure affect the availability and cost of natural gas. You can track transportation data from sources like the EIA or the Federal Energy Regulatory Commission, FERC. Demand is the amount of natural gas that is consumed by various sectors, such as residential, commercial, industrial, and electric power. It depends on the weather, economic activity, and consumer preferences. To analyze demand, you need to monitor the following indicators. Weather. This is the main driver of natural gas demand, especially for heating and cooling purposes. Cold winters and hot summers increase the demand for natural gas. You can track weather forecasts from sources like the National Weather Service, NWS, or AccuWeather. Economic activity. This is another driver of natural gas demand, especially for industrial and electric power sectors. Higher economic growth and output increase the demand for natural gas. You can track economic indicators from sources like the Bureau of Economic Analysis, BEA, or the World Bank. Consumer preferences. This is a factor that affects natural gas demand, especially for residential and commercial sectors. More people switching to natural gas appliances or vehicles increase the demand for natural gas. You can track consumer trends from sources like the EIA or the American Gas Association, AGA. By analyzing these supply and demand factors, you can get a better understanding of how natural gas prices move and what are the opportunities and risks for your trading strategy. In the next section, we will look at how to use technical analysis tools to identify entry and exit points for your trades. Technical indicators and chart patterns are useful tools for natural gas traders to identify trading opportunities and entry/exit points. In this section, we will discuss some of the most common technical indicators and chart patterns for natural gas trading. Technical indicators are mathematical calculations based on the price and volume of a security that provides signals for the direction and strength of the trend, momentum, volatility, and support/resistance levels. Some of the most popular technical indicators for natural gas trading are moving averages. Moving averages are the average price of a security over a specified period of time. They help smooth out the price fluctuations and show the direction and strength of the trend. For example, a 9-period moving average is the average of the closing prices for the past 9 periods, including the current period. When the price rises above the moving average, it indicates that investors are becoming bullish on natural gas. When the price falls below, it indicates a bearish trend. As well, when a short-term moving average crosses above a longer-term moving average, this indicates an upswing in the market. When a short-term moving average crosses below a longer-term moving average, this indicates a downswing in the market. Stochastic oscillator. The stochastic oscillator is a momentum indicator that shows where the price closed in relation to its range over a specified period of time. The stochastic values range from 0 to 100%, where values above 80% indicate overbought conditions and values below 20% indicate oversold conditions. The stochastic oscillator also has two lines, %K and %D. %K is the raw stochastic value and %D is a smoothed version of %K. When %K crosses above %D, this signals a bullish momentum. When %K crosses below %D, this signals a bearish momentum. Relative Strength Index, RSI. The RSI is another momentum indicator that measures the speed and change of price movements. The RSI values range from 0 to 100, where values above 70 indicate overbought conditions and values below 30 indicate oversold conditions. The RSI also shows divergences between the price and the indicator, which can signal trend reversals. For example, when the price makes a higher high but the RSI makes a lower high, this indicates a bearish divergence. When the price makes a lower low but the RSI makes a higher low, this indicates a bullish divergence. Average True Range, ATR. The ATR is a volatility indicator that measures the degree of price movement or fluctuation over a specified period of time. The ATR is calculated by taking the greatest of the following: the current high minus the current low, the absolute value of the current high minus the previous close, or the absolute value of the current low minus the previous close. The ATR helps traders determine how much risk they are willing to take and how to set their stop loss and take profit levels. High ATR values indicate high volatility and low ATR values indicate low volatility. Chart patterns are geometric shapes formed by the price movements of a security that provide clues for future price direction and potential trading opportunities. Some of the most common chart patterns for natural gas trading are: ascending triangle. An ascending triangle is a bullish continuation pattern that occurs when the price fluctuates between a horizontal upper trend line and an upward sloping lower trend line. The upper trend line acts as resistance and the lower trend line acts as support. The ascending triangle indicates that buyers are more aggressive than sellers and that demand is increasing. The pattern is confirmed when the price breaks above the upper trend line with an increase in volume. The breakout target is calculated by adding the height of the triangle to the breakout point. Descending triangle. A descending triangle is a bearish continuation pattern that occurs when the price fluctuates between a horizontal lower trend line and a downward sloping upper trend line. The lower trend line acts as support and the upper trend line acts as resistance. The descending triangle indicates that sellers are more aggressive than buyers and that supply is increasing. The pattern is confirmed when the price breaks below the lower trend line with an increase in volume. The breakout target is calculated by subtracting the height of the triangle from the breakout point. Head and shoulders. A head and shoulders is a bearish reversal pattern that occurs when the price forms three peaks, with the middle peak being higher than the other two peaks. The peaks are called left shoulder, head, and right shoulder respectively. The pattern also has a neckline, which is drawn by connecting the lows of the left and right shoulders. The head and shoulders indicates that the uptrend is losing momentum and that a reversal is likely. The pattern is confirmed when the price breaks below the neckline with an increase in volume. The breakout target is calculated by subtracting the distance from the head to the neckline from the breakout point. Inverse head and shoulders. An inverse head and shoulders is a bullish reversal pattern that occurs when the price forms three troughs, with the middle trough being lower than the other two troughs. The troughs are called left shoulder, head, and right shoulder respectively. The pattern also has a neckline, which is drawn by connecting the highs of the left and right shoulders. The inverse head and shoulders indicates that the downtrend is losing momentum and that a reversal is likely. The pattern is confirmed when the price breaks above the neckline with an increase in volume. The breakout target is calculated by adding the distance from the head to the neckline to the breakout point. To use technical indicators and chart patterns to identify trading opportunities and entry/exit points for natural gas trading, traders need to combine them with other factors such as fundamental analysis, market sentiment, risk management, and trading discipline. For example, if traders see an ascending triangle forming on natural gas futures chart during an uptrend, they may look for confirmation from technical indicators such as moving averages, stochastic oscillator, or RSI to gauge if there is enough bullish momentum to support a breakout above resistance. If they see positive signs from these indicators, they may enter a long position when the price breaks above resistance with an increase in volume. They may set their stop loss below the lower trend line or below the most recent swing low. They may set their take profit at or near the breakout target calculated by adding the height of the triangle to the breakout point. They may also monitor fundamental factors such as supply/demand balance, weather conditions, inventory levels, production levels, and geopolitical events that may affect natural gas prices. They may adjust their position size, stop loss, and take profit levels according to their risk appetite, trading objectives, and market conditions. They may exit their position when they reach their profit target, when they see signs of reversal or exhaustion, when they see conflicting signals from other indicators or patterns, or when they encounter adverse events or news. This way, they can use technical indicators and chart patterns to trade natural gas more effectively and profitably. Natural gas is a volatile and dynamic market that offers many opportunities for traders who want to profit from its price movements. However, trading natural gas also involves managing risk and diversifying your portfolio with different products and strategies. In this section, we will explore some of the ways you can do that. One of the most common ways to trade natural gas is with futures contracts, such as the Henry Hub natural gas futures contract on the CME. Futures contracts are agreements to buy or sell a certain amount of natural gas at a specified price and date in the future. They allow you to lock in a price today and hedge against future fluctuations. However, futures contracts also have some drawbacks, such as high margin requirements, rollover costs, and physical delivery obligations. Another way to trade natural gas is with options contracts, which are also available on the CME. Options contracts give you the right, but not the obligation, to buy or sell a futures contract at a certain price, called the strike price, before or on a certain date, called the expiration date. Options contracts can be used to speculate on the direction or volatility of natural gas prices, or to hedge existing positions. However, options contracts also have some disadvantages, such as time decay, premium costs, and lower liquidity. A third way to trade natural gas is with contracts for difference, CFDs, which are offered by some online brokers. CFDs are derivatives that track the price of an underlying asset, such as natural gas futures or spot prices. They allow you to trade natural gas without owning or delivering the physical commodity. You can trade CFDs on margin, which means you only need a small percentage of the full value of the trade as collateral. You can also trade CFDs in both directions, meaning you can profit from rising or falling prices. However, CFDs also have some risks, such as leverage, overnight fees, and counterparty risk. A fourth way to trade natural gas is with exchange-traded funds, ETFs, which are listed on stock exchanges and can be bought and sold like shares. ETFs are funds that hold a basket of assets related to natural gas, such as futures contracts, stocks of producers or distributors, or physical commodities. They allow you to gain exposure to natural gas without dealing with the complexities of futures or options contracts. They also offer diversification benefits and low management fees. However, ETFs also have some limitations, such as tracking errors, contango effects, and tax implications. A fifth way to trade natural gas is with shares of companies that are involved in the production, transportation, distribution, or consumption of natural gas. Shares of natural gas companies can reflect the performance of the natural gas market, but they can also be influenced by other factors, such as earnings reports, dividends, mergers and acquisitions, or regulatory changes. They allow you to invest in natural gas with a long-term perspective and benefit from capital appreciation and income generation. However, shares of natural gas companies also have some challenges, such as market risk, company risk, and sector risk. As you can see, there are many ways to trade natural gas depending on your goals, preferences, and risk appetite. You can use different products and strategies to manage risk and diversify your portfolio with natural gas. However, you should also be aware of the advantages and disadvantages of each method and do your own research before entering any trades. Natural gas trading can be rewarding but also risky, so you should always use proper risk management techniques and follow a trading plan.